Statistics show that only 20% of small investors ever come close to achieving their investment goals. The other 80% get eaten alive by investment sharks, investment advisors, fund managers, and other people trying to outline the pockets with your hard-earned cash. Motivated by a sense of fair play, Professor Philip Cheng resolved to write an investor survival guide in which he would share everything he've learned in his years as a successful professional investor. The result is Taming the Money Sharks. Since its first publication in April 2012, Taming the Money Sharks has been on the commercial press best-selling list in Hong Kong for 3 months. With me today is the man himself, Professor Philip Cheng, retired Chief Investment Officer at MetLife Taiwan, a wholly owned subsidiary of MetLife Inc., New York, the largest life insurance company in the US, with approximately 800 billion in total AUM. Now, since 1996 and during his 11 years as Chief Investment Officer, Professor Philip Cheng managed a diversified portfolio with total assets under management of approximately $2 billion US. In the last few years, he has been an active conference speaker on global financial topics. And he has been also appointed as an adjunct associate professor of finance at the University of Science and Technology in Hong Kong. Professor Philip Cheng, thank you for your time for this interview.
Thanks for having me.
Professor, now the thing is, you have been to both of the spectrums. Obviously, you are one of the sharks when you manage a fund, there's large fund for an insurance company, MetLife. And of course, I believe you're also a retail investor as well. Now, having been to both spectrum, what do you think individual retail investor wanting to get rich, but generally they fail miserably?
Well, it's a great question. Of course, we all are in different situations as a small investor, but we all want to make money. There are mainly 3 reasons why most of the small investors cannot be successful. Number 1 is time. Most investors are very busy with their own regular work, and they do not have the time. It could be their family, it could be other priority activities. They do not have time to do the stock research that they should be doing before they invest. That's number 1, time. Number 2 is experience. Most of the investors are not directly in the investment business. They may be related to investment, but if it's not in investment, it's very difficult to know the stock as to which stock is good and what price to get in and what price to get out. So the second point is experience. Number 3 is focus. Most individual investors are generally bombarded by misinformation in the marketplace. They invest on those information alone without doing the kind of research or homework that they need to do. Even simple homework. They are listening to so-called noises in the marketplace. And then they buy, sell stock on that basis. And so that's also a big reason why they lose money, is to not have the focus. So there are 3 things: time, experience, and focus.
Right, that's excellent one. Regarding the third point, Professor, I have a further question. As in, when you say about the information, now everyone was reading the news from the media and things like that. Now, how do we actually filter this kind of information? Is it like doing like due diligence is important and stuff like that? Yep.
Yeah, it's a good question. See, I have a lot of very good media friends, and they're all working very hard to find information for investors. So they report a lot of information derived from different sources, from big investors, from big companies, etc., etc. So they are reporting whatever has been designed for them to report. So that is something that in my book, especially in chapter 3, I try to explain to the investors how to listen to the reports that media give us. The media friends work very, very hard to bring good information to investors. So they can only report, but it's up to the investors themselves what to consider as good information and good knowledge. And that's a big thing in my book, to tell the people what to condition themselves and to be able to differentiate what is noise and what is good information.
Right. So, but the thing is, again, to relate to one of your the first point that you mentioned, and because in the perspective of a fund manager, I think you have a lot of time and the resource to read and filter those information, differentiate what is true information from noises. But this takes time, this takes effort, which a retail investor actually lacks. Wouldn't you put it like that, Professor Cheng?
Well, yes. See, as I mentioned, most of us do not have enough time to evaluate stocks. And yet we want to make some money to better our life. And that's why this book is make it so simple to follow certain rules, to follow certain maxims, and to be able to buy and sell stocks and make some money consistently. And see, let me go back 1 second. See, there are many kinds of sharks, but there are 2 groups of sharks. The first type of sharks, they are simply large operators in the stock market. They execute large buy-sell orders every day for their own needs. So they do not purposely attack the small investors or any other investors for that matter. They just have to operate their own large portfolio. However, if any small investors get into their way, they will get hurt. So that's what I call the good sharks. They are just huge operators. Then you have the bad sharks, what I call malicious sharks. See, they would purposely scheme against any investors, even big and small investors. These sharks would use deception to trick and to attack the unworried investors, causing blood loss or total incapacitation. See, that's why we have to watch especially for these so-called bad sharks. See, they hurt the investors mostly by influencing the stock markets by many means, including originating misinformation for their own personal gain. And so these are the people or source of information that we have to be careful.
Right. So you're saying that this information, especially from the malicious sharks, like what you mentioned, that are the one that we should be really be aware and very cautious with.
That's right. That's why in chapter 3, I took a lot of time in explaining to regular investors how to get information and who to get information from. And that is just as important as just accepting information as knowledge. There's a difference between regular information, investment information, which we have a lot from everywhere, from the books, from newspapers, from TV, and that's also excellent, good stock information, and we need to tell. And that's why chapter 4 is very important, is how to able to evaluate information as good as anybody else.
Right. So, and then that would actually decreases, the likelihood we are being tricked by the malicious shark, so to say,
Right.
Right. Just maybe sidetrack a bit, Professor. So when you you are managing a large fund, yeah, in your career, and MetLife, and you are obviously one of the good sharks. So when things like this happen, so to what extent are the good sharks are all also hurt by the bad sharks at your level? I mean, at that time.
No, we don't. Because sharks, when we get to a certain size, both good sharks and bad sharks sort of know each other already. So we don't usually hurt each other. We just sort of coexist with each other. The bad sharks make their money, the good sharks make their money. But sometimes the small investors get hurt. Let me give you one example. When we are accumulating a position, for example, in any asset, we start buying in the open market, for example, and we accumulate every day. The volume goes up. And most of the time, we see some small investors, they may track the volume of a certain stock or a certain asset, so they will follow us in also buying after us. And so that is good. We give them credit. However, once we finish buying, when we have to sell at a certain time, the small investors don't know even the good sharks' own plan of investment. And so they would get hurt because they don't know when to sell. But we maybe start selling for our own company needs. And so that's why following a shark can also be dangerous. We don't hurt them on purpose, but we have our own investment plan too, to buy and to sell. And that is important. And that's different than the so-called bad sharks. The bad sharks would create information and then to lure investors into certain areas, so then to buy and to sell, and then they capitalize on the small investors' mistakes. So they create not so good information to influence the stock price for their own personal gain. So that's a big difference between a good shark and a bad shark.
Right, and there's no way, an investor know, because just looking at the volume transaction doesn't show you whether it's bad shark or good sharks.
That's right.
That's right.
That's why in my book, I've seen like at least 100 books how to buy stocks, and that's why I try to do something very original in my book. And there are three major differences in my book versus, say, 99 other stock investment books. So, number one, during my 40 years of experience working in banking and investments, I have played with many types of sharks, good sharks and bad sharks. See, I was buying and selling, I was in a foxholes, literally every day fighting the battle. So this battlefield experience is beyond some fancy model or some fancy theory. I do not need to repeat other so-called stock gurus' anecdotes or their stories. I saw blood every day myself.
Wow.
The many books tell readers what not to do, and I do too. In my Taming of the Money Sharks book, I also tell them what not to do, but also tell the readers what to do. And in fact, I do have a flow chart to literally hold the reader's hands and guide them step by step what to do and what not to do. So that's point number two. The third major difference is this stock market everywhere, whether it's in Malaysia or whether it's Singapore or Hong Kong or New York or London, there are always sharks in almost every stock market. If any individual investor wants to swim and still survive, they need to know the right information and follow certain actions. Individuals can never kill the sharks themselves, because the sharks by nature are very powerful.
Yes.
They're cunning. But certainly by coexisting with the sharks, you can swim in your own waters and still get rich. You don't have to swim in the waters or where the sharks are.
Yep, that's really a great 3 points on how these books are different, because I read them myself, and I think this 3 point, especially flow chart, I think you need to get this book to really look at the flow chart itself. Yeah, Professor.
Yes, I know. I took a lot of pain in making things simple, and I have not seen one single book that have a flow chart in buying stocks to go through the step by step and go through what to do and what not to do in the book, because most investors do not have the time to do a lot of homework, to do a lot of research. They are very busy, as I mentioned earlier.
Yeah, that is really something I can relate to, and that's the just additional info. Professor Philip is actually his first degree was an engineer by training, and I think engineers like flowcharts very much. It simplifies things when we want to present it to non-engineers. I think that is what a professor has strived, to make it layman for compress everything, distill. Yeah,
that's a good point, because I think through a flowchart, people can look at a picture and know where they are in their decision making to buy a stock. For example, let me just very briefly go through. Say, the first step is you have to stay cool. Instead of listening to tips from your good friend, from your relatives, etc., and listen to the tips and then go ahead and buy something just because it's a hot stock. That is the worst thing anyone can do. But I find out that I met so many individual investors from New York to Hong Kong to everywhere in the world. 99% they still do it this way, because they thought if they do not buy after a good stock recommendation, they run out of opportunities to make money. and this human emotion that has been making a lot of people lose a lot of money, because they rush into something without staying cool. And say, Professor Philip, why is it so difficult to... No, if you look around yourselves, look at how people lose money, including myself. I lost money that way myself, as I mentioned in the book, when I was a young engineer.
Right.
I didn't know any better. So I lost money. So I'm also the one to blame when I did not know the right rules. See, like in any field, you have to know the right information. Even playing sports, I like a lot of sports. I like baseball, I like football, I like tennis, I like badminton,
right.
I like golf.
Right.
Every sport have their own rules. You cannot be like a good tennis player and then suddenly go to a football field and say, I'm also good in football. No.
Right.
Vice versa. You can be a good football player and walk into a tennis court and say, hey, tomorrow I'm going to be a good tennis player. There are always rules to follow in any sport. That's why I'm amazed at how many people, they jump from one stock in one industry to another stock in another industry and thought they can also make money. I never understood that.
Right.
So choosing the right industry is the second step, as I mentioned in my book. And how to choose it, I guess Mr. Lieu, you also know.
Yes. I read that a few chapters, maybe more than once. Yeah. Yeah.
It's like in chapter 2, I began to introduce people to find an industry, obviously a good industry. But to start with, find out what you are working with. For example, in the book I mentioned John as an example. He's a good IT person, department head of an IT department. Yet he loses money in stock market every day, every year. Then I said, you're a smart guy, you have high IQ, how come you lose money? And he told me he just listened and jump from industry to industry, then I recommend him to stay in one industry, in this case his own profession, the IT industry. And he asked him look at stocks like IBM or Apple or Samsung or Qualcomm, any of these, Hewlett Packard, any of them. Look at the industry, look at the best players in the industry, and then start following the trend, follow the history, and do some simple research. Bingo, to make a long story short.
Right.
He was making money every year now, and he's a very happy IT guy.
Yes. And more peace of mind.
More peace of mind too, and that's so important. See, my book basically start to hold the hand, follow the flow chart, to buy stocks, and you can have a worry-free portfolio practically, because when the stock goes up or go down, you don't worry about the portfolio because you know what you have done.
Yeah, that's
and
right.
Choosing the industry is also important because, as you say, Mr. Liu, that if you are concentrating on one industry, every day, one day report on industry news of another industry that you do not have stock in. For example, if you're in the IT industry, and when they're reporting about, for example, the aircraft industry or the transportation industry, it's not that important. You have to chase after that. So, and to be able to be calm and peaceful and blissful in following one or two main industries, your lifestyle will be happier, and you are making money at the same time. And that's what I really want to influence people to, in this Taming the Money Shark book, to have a worry-free portfolio and yet at the same time make good money in the stock market.
Yep. I think Professor Philip, you actually, people like, if you heard it from someone not a fund manager, probably that this advice is not so convincing. And the reason why I want you to, I want to interview you is because you have been the good sharks. So if it's come from someone who has been there, done that, and with credentials, you have managed a big money, I think that is a very prudent advice that everyone should follow. Yeah, that is what I believe. Yeah.
No, you're right. Let me just remind you, Mr. Liu, there are 68 industries at least in the world. Even you don't sleep, you and I don't sleep, or any investor don't sleep, and try to be good in 68 industries.
Yeah.
It's impossible. Even if you don't sleep, you have to eat, you have to work, you have to do whatever you need to do.
Right.
And so 68 industries, too many now. In a large company where I used to work, or in large big banks or large investment companies, they can afford to hire 68 people and have one person to track one industry. That's why they are so successful. But as an individual, small investors, we cannot be able to good in 68 industries. We cannot be good in IT at the same time, say good in real estate. Or be good in, say, shipping. We cannot do that because in each industry there is terminology to understand. There are rules you have to follow, as I mentioned, just like playing sports. If you know the rules in tennis, you may not know the rules in soccer or in basketball. They are different. So how do you expect to make money and to be good in any one sport, or in this case in stock investment, and jumping from one to the other? And that's why it's a big point in the book is to find some industry that you're good in or you like. Like, for example, I mentioned about Mary as an example. She's an accountant. She doesn't like to do her own profession. She said, I'm tired of figures. I'm tired of balance sheet information.
Right.
I want to be a happy person. I like to go shopping. I said, fine. Even if you like your own hobby or person to be shopping, and go with it. Look at the luxury goods which she likes. She likes to shop at Gucci, Tiffany, Rolex watches, and you name it, Ferragamo. all the big brands, and she does her market research every day. And I teach you in this case chapter 4 how to read simple financial statements and what to look for. And suddenly, instead of losing money every year, she's a very happy accountant.
That is awesome. That is awesome. That's
these are all real because I look at from a people's standpoint. I don't expect them to have a CFA or CFP or PhD or MBA to make money in the stock market. They do not need those. So if you follow this book step by step and how to use information, how to study one industry. Of course, in chapter 4, I mentioned how to look at the stock. How to pick a good stock in the industry, and when I was in training in Wall Street in New York, we were trained to do 36 financial indicators. 36, yeah. To make a decision to lend to a company or to buy their stock. But I know if I put down in my book, like some other books, I put down 36 financial indicators for my readers to follow. You know one thing, Mr. Lieu? They will not follow.
Yes.
They say, Professor Philip, you're a crazy man.
Right.
I don't have time to do 36 indicators for every stock I buy.
Right.
So then I go back to square one. Then I start to look at out of 36 manageable size, maybe 1, maybe 3, maybe 5, maybe 7. But not 36. So I decided on 5 key indicators for you to know how to screen a bad stock from a good stock.
Yep.
And it's 5, only 5. And if you do the 5 consistent and know them, that will be good. Now, one other thing is, out of the 5, one thing I really want to talk about is the cash flow. Most people always ask questions, does the company make money? Then I say it's a wrong question.
Right.
Professor Philip, you're a crazy man. I want to find a company makes money. I said, no, it's a wrong question.
Right.
The question you should ask is, does the company produce cash flow from their operations?
Yes, from their core business, yeah.
Is it the same? Oh no, they are not the same. When a company makes money does not mean they generate cash flow from their operations.
Yep.
So it's a simple thing like this that I tell you, through these years, I have tried to manage to teach people to make money by looking at the cash flow in a company and not earnings.
Right.
So that's a huge difference between cash flow.
Yeah.
I went through many bad experience myself. When I was very young, I also asked the same question: does a company make money?
Right.
If they make money, they must be a good company. No.
Right.
I have screened companies out from my lending activities. I used to be a corporate lender.
Right.
Because they make good money on the income statement, but they have no cash flow from the operations.
Yeah.
They borrow their money from the bank to run their daily business.
Right.
So they keep on building up debt on the balance sheet, and it shows up as good earnings per share, etc. But that's wrong.
Yeah. It's hard cold cash, yeah. You should.
Only cash can run a business.
Yeah.
Can decide. Now, of course, don't get me wrong. Earnings obviously is a very good indicator, financial indicator. But the key thing to buy and sell stock is to look at the cash flow. And cash flow meaning from operations, not from funding activities.
Right.
The natural. If you say if there's a grocery store, they should be selling meat and milk and potato and tomato, etc. And if they are in IT, they should be selling computers or iPhone or whatever, not from funny business of other things. So that's a big difference. Then if you can screen company and buy stocks using this, it'll help you tremendously. This is only one of the 5 indicators
Right.
in the shark book.
Yeah, and these are the basic questions, I would say, and retail investors should ask themselves when they are screening company. And to summarize it, to summarize it is to say make hardcore cash from their core business or operations. Yeah.
That's right.
Yes, right.
Yeah.
Yeah. Professor Philip, I actually have now just I just filtered like a few questions from my readers. Yeah.
Oh, sure.
Yeah.
Sure.
So that will be interesting. So there's one reader that asks, you say since you have been in both spectrum. Let's say there's also private fund managers, yeah, who manage money for retail investor. Let's say they don't want to invest directly in stock. They want to, but if they don't want to invest directly, they'll rather give the money to a private fund manager, okay, to invest.
Right.
So it says that what is your take if we were to say that you want to invest in stock, but I really don't want to do homework, I'm lazy, yeah, I want to just give the money maybe to a private fund, and maybe you maybe yourself, with your credential you can set up probably private fund who actually help people to invest, yeah, and just pay maybe 1.5% or things like annual management fee, and let you handle all this. What is your take on that? Obviously this is not something that was covered in your book, but this reader was very interested to hear your view.
Okay, good. Now, this is an excellent question because many of us still don't want to buy stocks on our own, and they hire a financial advisor or investment advisor. That's fine. And there are many articles already written on how to choose your own financial advisor. But let me add my viewpoints to it. Yes, usually there's a whole bunch of rules and regulations that you follow, how to pick a good one. And they may all be fine, but let me highlight just a few points, which I myself think is extremely important. Number one is, after you have gone through the credentials of your advisor, like where they go to school and how many years they work, on and on, basically resume information, that's fine. And you still need to do that. But more important thing is to ask them, during good times, how do they manage their portfolio if your money is their money? What happened in bad times? And only through the bad cycles in the stock market, and you teach and you ask them, for example, in this case, we all remember 2008, 2009,
Yep.
what happened to the stock market. And that's not too long ago. And ask your advisor, how did they do? And if they make money, how do they make money? If they lose money, how much did they lose? What did they do to reduce the losses? See, there are portfolio managers around the world in 2008, 2009. Many of them also lost money. But how do they lose money less than most people? And that's more important than during good times when everybody makes money. Then they will look at my track record.
Right.
No. And then that is number one. Number two, follow their logic, not just the stock they buy. If they, for example, if they buy IBM or buy Apple or buy Samsung or any of the big maker companies, what did they do? What did they do to really be able to outperform the market? They lose money less when they're bad market, and they make more money when they're good market. And the logic, go through the reasoning, not just buy, sell stock. How do they come to the logic? And when you learn their logic, their reason, their thinking, then you will learn this person's real experience and the way to deal with fire when the fire breaks out. And that is 10 times more important than look at the credentials of where they went to school and how many years they worked at some investment company. So that's my humble opinion. And I learn a lot myself when I interview financial advisors. They are used to be able to be in those situations. When I manage a portfolio, there are areas which I have to farm out to other financial advisors, because in my portfolio I cannot be good in everything.
Wow.
For example, I need to farm out at one point in time the emerging market area. Because if I follow the major market, that's fine in my department. But there are certain areas in the emerging market very tricky.
Right.
I do not want to hire a department or a section just to manage emerging market. So I'll say, okay, Philip, you don't have the expertise. Now you have to hire an advisor outside, outsource it, somebody. And then I interview many investment companies. They claim they are good in the emerging market stocks. But when I start asking them, when the emerging markets go bad, how do they do it? Many of them, they only can tell me how the fancy models that they have and fancy chart. They do not know how to handle adversities. And that's why I also mentioned very briefly in chapter 3 as to what to look for. Similar to what I said, yes.
Which is the
If
logic.
I answer your question.
yes, definitely. The logic, logic behind, the logic behind. What's the decision? And when the the metal is really tested when there are really like bad times. And what I think and there's another way, perhaps Professor, to really quantify it. Maybe we want to look at how the fund, the private manager performs over a complete bull and bear cycle. Is that a fair comment to say so? And besides the logic itself,
yes, that is important too. But I would not. They could reference information, of course, but I would not put too much weight on what they have managed, because almost always they will find good information to show you how well they do. And so I tend to, use them as good reference, but always want to dwell in how successful they fight the fires. That is 10 times more important than all those fancy charts with the curves always going up. I think I would tend to ask difficult questions and have them come back to me. If they don't have the answers, fine. I want them to come back to me, and so because I never know when the next recession is going to be, Mr. Lieu.
Yes.
I want to be able to say, okay, good times, we all prosper, we all happy, we are opening champagne and everything. I want to know when in bad times, with my money in their hands, how do they handle bad times?
Yep.
So that is, to me, more critical.
Yep. And to talk up to this Professor Philip, what he just said, if I might sound a bit crude, but Professor Philip actually wants to know what will you do when the shit hits the fan.
So what I do is that's why I go back to this book. Frankly, I still make mistakes because I'm human, subject to human emotions, like everyone in the world. But I make much less mistakes now than when I was, say, 10, 20 years ago.
Right.
Because go back to chapter 1, very basic.
Right.
During good times, I'm not overly happy because I know I have to when to get out. I have to take profit at some point in time.
Right.
During bad times, during the stock market, I'm actually happier than good times. I said, why? I said, because that's the time when a lot of good stocks are undervalued.
Yeah.
That's the time I can really pick them up, and then I can sit on them for X number of weeks. Then when it comes back, see, that's why bad stock market actually is a good thing. If you read the book, because now you can get them at good value using the chapters as to how to find good stocks and how to buy, sell stocks, and these are all really important. So the stock market, whether it's good or whether it's bad, is still good to know and follow the book. It's a good time.
Yep, that's absolutely it. I think to top up 2 points, I think I'm very humble to be, even, someone like your credential professor. There's 2 things you admit. You say, I'm just human. Okay, I make mistakes, yeah, but much lesser mistake. And if we just make lesser mistakes and make more good decision, I think we'll be doing just fine, especially when it comes to investment. And the second thing that I caught on what you say is that even you, in your position, so many years as a institutional investor, and you admit you don't know everything when you mention about emerging markets. And with that, it's very humbling of you, to say so, because a lot of people, even retail investors, they thought they know everything. But even at your side, you say, there are things that I don't know that I need to outsource, yeah? So that is a very humbling statement. So I think everyone can, really learn from your mindset and stuff.
Thank you for the kind comments. For me, buying and selling stock is like fighting a battle.
Right.
You have to know your own resources. How much do you have? And you have to know your weakness. You have to know your strength. And buying stock is not fun. I mean, it's like fighting a battle, and we have to treat it as fighting a battle. And to be able to not to subject to emotions as much as possible. Like in chapter 7, I did mention about people loving a stock. And lose a lot because they fell in love with the stock.
Right.
And that's not so good either, because again, we're human. I know many friends who fell in love with the stock, and when the stock goes down, they don't want to sell because I used to make so much money from this stock, and it's still good company. On and on and on. And finally, before they know it, they lost all their money because they don't know how to take a stop loss. And that's equally important. There's a discipline has a certain place in stock market also.
Right. I think there's a lot of good stuff there. Perhaps, Professor, you have time for one related question. Last question.
Certainly.
Yes. Related to what you just said, I mean the cut loss and the take profit. I mean, ultimately, you need to take profit or need to cut the loss, especially if the fundamentals of that stocks are deteriorating for whatever reason. Now, as a institutional investor, I think you have mentioned it's pretty easy decision because you have your mandate of what to do. But for retail investor, you talk a lot about discipline. So can you elaborate more? Then this is one of our readers' question, like when to cut loss and really when to actually realize the profit for retail investor?
Oh, that's an excellent question because, like as I mentioned a little bit in chapter 4 on how to sell stocks or when to sell stocks. Once you know an industry well, each stock is different. Some industry, the fluctuation of the stock price in some industries a lot. Say, pick a number. Say easily 10%, 15, 20% easily in any 1 year. And some stock doesn't move that much throughout the whole year, a typical year. It may move 2%, 4%. So each industry is different. Let me give you an example. For example, if you are in certain construction industry or building industry or real estate industry, from a cycle, a bad cycle to a good cycle, the movement can be quite large. On the other hand, if you look at what we call utility companies, like the power companies, electric company, water company, yes, they do have fluctuations. They tend to not fluctuate that much. So that's I go back to chapter 2 again. Once you know the industry, you get a feeling from the industry, from the history, from the company, how much variation you should set in your stop loss percentage. For some industry, you may have to set a stop loss at say 15%, 15%. For some industry, you may have to set at 5%. So that's why each industry is really so critical to know one industry well, because each industry, the stop loss is different. When you look at the technical charts, it's also different because of the volatility of the stock, the volume, etc., etc. And so that's why how to stop loss is most people give information the wrong way. Say, oh, just take an X%. No, you have to go back to your own industry and look at historically what happened to the industry during recessions or during good times, and your particular stock during good times, during bad times, and get a sense of what the fluctuation is. And that is so different than other industry and other stocks. And if you follow that, you'll be a happier person, and you will cut your loss, and you'll make a lot more money over the long run.
Right. It's a really great comment over here, and I like your last phrase saying that over the long run, over the long run, because it is a long run. It is a long-term kind of thing. I believe it's the way you manage your portfolio too, as the shark, good shark last time, as in, it's about all the value, long-term instead of, the short-term trading and stuff, which I don't think that is what your book is about too,
Now, some people can make money in the very short-term trading in and out, but that's by far the minority of most of us.
Right.
People can, because we are so busy with so many other things. But if you follow the book, you can do short-term or long-term, depending on how much time you have. Now, some of us are not working. Then they can spend 8 hours a day looking at the stock market. Some of us are very busy with our family, with our work, and they may only afford 1 hour, 1 week to do that. And even that, you can still make good money if you follow the book. So it depends on each of our profile in our lives. We are different, and our time to allocate to making money. But making money is important because I think we should be able, if you're successful, we should be able to retire early. Or at least if you don't retire early, you should have a peace of mind in your life. Not to worry about employment, worry about money. You can at different times maybe take some good vacation, buy something that you like, or get to a better house, or whatever. So I think the stock market does give you that way to better your lives if you follow the right way. That is.
Wow, that's absolute awesome stuff. Professor Philip, what is the age when you retire previously? Are you consider yourself retire yet?
No, I do enjoy the financial area, investment area. I don't think I'll ever retire. Not because of money, but I just enjoy education. I enjoy helping people to better their lives, and that's why it took me 3 years to write this book.
Wow.
And that's why in Hong Kong last year was a bestseller, and I was very happy. I didn't expect that to be a #1 bestseller for 3 months in Hong Kong, because people want to know something simple. They want to know something they can follow without getting into a lot of investment jargons. And the flow chart, they can help them to step by step. So when they buy the book, they can learn step by step without spending so much time worrying about things that they do not have to worry. Yes,
I believe in that. Absolutely great stuff. Actually, what Professor Philip was saying, that he is retired a long time ago. Now he's just doing this for fun.
I do enjoy helping people a lot. I teach my students how to learn how to do investment. Hopefully, if they want to retire early, they can. It's not impossible. If they want to enjoy working whatever area, that's fine too. But I am thinking about the peace of mind or the financial independence that people are not getting it. So many people in these days. And that's why I wrote this book, helping them to achieve what they want to achieve early in their lives.
Absolutely agrees to that. Absolutely. Professor Philip, it's really been a pleasure talking to you. Sorry for dragging this a bit late, 10 minutes what I expected, but it's really been a great experience. I think everyone hearing this too, have been a great experience talking to Professor Philip Cheng, who has been there, done that. You can call him a good shark. and
this book is now available in Amazon now.
Yeah.
So if anybody wants to take a look at it or buy a copy, I think it will be benefiting immensely in their lives.
Yes, I believe so. Any last words, Professor Philip, before we wrap?
Last word, I feel that we are all, whether we are rich or poor at this time, we all should be given opportunities to make more money and have better lifestyle. And stock market is one of the many ways that one can consistently make extra money to better lifestyles, but that they must stay away from the sharks because there's so much information. If they follow the wrong information, they will get burned, they will get hurt. And so I just hopefully, and I wish everybody can be happier in their lifestyle through the stock market.
Well, that's absolute good conclusion, Professor Philip. Really, thank you very much.
Yeah, thank you for your time.
Yeah, thank you.